Hello, everyone, and welcome back to another episode. I'm your host, a Millennial Investor, and it is time. It is time for our monthly update. Every single month, we give these updates for my annual dividend income, my monthly dividend income, portfolio value, and monthly YouTube income. So if you haven't seen this before, these are the 22 companies that I own on the left, and I'm about to give you the update for these top two charts right here. So go ahead and take a mental picture of these charts, and I'll give you the updates here in 3, 2, 1. And there you go. There is the new update for these two top charts. We increased the annual dividend income again, like we pretty much always do. We went from $388 up to almost $410, so a little increase there. And then as far as the monthly dividend income, we all know for me, is based on the companies that I own, that March, June, September, and December, if I said that correctly, are the big months for my portfolio. So April is a little bit of a slower month, and then May is going to be a lot lower, probably likely like in the low 30s, maybe in the high 20s, but still not a bad month. $38 is way better than where I started, because if you go back just 6 months earlier, you can see the numbers significantly lower. But we've come a long way, and I'm really excited for the future. But let's go ahead and take off these, and let's go ahead and go to portfolio value and monthly YouTube income. So once again, we have my portfolio value and monthly YouTube income, and these are the charts before the update. So let's go ahead and take a mental picture, and I'll give you that update now here in 3, 2, 1. And there you go. There's the new updated version of these charts. The portfolio value did go up this month as well, about almost $900. We went from $12,020 up to $12,901. And then the monthly YouTube income stayed pretty much flat from $238 to $253, and that's generally about average. I usually like to average around $200-ish a month. You can see that some are way higher, some are way lower, but generally speaking, about $200 or so is about where I stay at an average. But let's go ahead and go further, and let's look at my investing goals for 2021. My annual dividend income needs to reach $600. We're on track to hit that mark based on where we're at today. Portfolio value needs to hit $20,000. So far, we're almost at $13,000. YouTube income of $3,000. We should do just fine with that, especially after the big month starting off the year. 150 referrals to M1 Finance. That depends on how fast you guys can sign it up. And then 20 out of the 24 companies raise their dividend, which is doing great so far. And there's my 2021 stock market prediction. But as far as these stats go, I'll show you all these right now, and we'll go over each and every one of them. As far as the monthly YouTube income goes, $150 came from 5 referrals, $30 each from M1 Finance, and that was what helped a lot of this YouTube income. And then $103.28 just came from YouTube ads from you guys watching the ads on my videos. So thank you so much. And as far as the dividends go, I'll go ahead and showcase those to you. This is my activity feed for dividends. So let's see, let's highlight April. So April, we got a dividend from Coca-Cola for $3.56, dividend from Kimberly-Clark $4.64. The biggest dividend that I've ever received, which is WP Carey, that's my big payer, is now finally in the double digits. My first double-digit dividend payer, which is so significant considering my first dividend payment was 43 cents. So we've come a long way. Now getting a dividend payment of almost $14 just for one company. Realty income every single month, $3.44. Store capital, $3.77. Altria, $6.14. And then we finished out the month of April with JP Morgan Chase paying out $3.45. But if we go back here, I want to show a highlight real quick. I like to show this every month because I only own one company that gives monthly dividends. Most of them pay every 90 days, every quarter, every 3 months, right? So with Realty Income, it's the one exception that they pay every single month. And I want to show the growth over time because I like to give an update on this because this shows how my portfolio is growing every single month regardless of what the stock price does. In May of last year, almost exactly 1 year ago, it paid me 60 cents. The next month in June, 70 cents. July, 71. August, 83. September, 95. October, $1.42. November, $1.90. December, $2.09. January, $2.65. February, $2.87. $3.18 in March, and then $3.44 this month here in April, just 2 weeks ago. But you can see how it's a steady uptrend. So if you just think about this, how 1 year ago I started with such little money, and you look at it now, what originally started as pennies and just less than $1, 60 cents, 70 cents, 80 cents, it doesn't look big now, but eventually we crossed that $1 mark. And look how quickly we crossed the $2 mark. And then shortly after that, we crossed the $3 mark. And now it won't take very long to start to cross the $4, $5, $10, $20 mark. Eventually, I want to get to the point where it's 50, 100, $150 a month just from realty income and none of my other companies included, just that one company by itself. And you think about the cash flows that are constantly being reinvested back off this company, that just makes me own more of the company, more of my other companies as well, and this just compounds further and further dividend growth. But I hope you guys enjoy this video, and I really appreciate you guys for tuning in. So I'll go ahead and start with my number one position in my portfolio, which is Broadcom, targeted at 9%. Broadcom is a company that has tens of thousands of patents. Some of the best companies in the world have partnerships with this company, including big names like Apple. This company has a great yield, great dividend growth, and has had an awesome performing share price. Now, not only has this company performed well in the past, but in my opinion, I'm betting that it will continue to do well in the future. I started adding shares heavily in the low 200s and even in the mid 300s, but now that it's up to almost $500 a share, I still believe in this company. Hawk Tan, their CEO, is a compelling CEO. He's a great guy. I love what he's doing with that company. And basically, they're just one of the best semiconductor companies in the world, in my opinion. In the same way that a company like Apple is transitioning from a hardware company to more of a software company as they get their services business increased and stuff like that, Broadcom is the same way. They're transitioning from their old, boring microchips, and now they're transitioning to software, a more higher margin, profitable business. And the cash flows of this company is ridiculous. So Broadcom, one I love, one that returns a lot of capital to shareholders, and one I'll be betting on in the future. Now let's go further and let's look at my second largest position, and it's tied for both of these real estate investment trusts. So I'll bunch them together. We're looking at WP Carey and Realty Income. Oh, and by the way, since the portfolio has grown from $1,500 now upwards of over $13,000 now at today's update, you can see that I have over 3 positions now that are over $1,000, so that's really cool. Our companies that I love, and basically these are both triple net lease real estate investment trusts, and both of these are two of my biggest dividend payers. Actually, I believe they are my number one and number two if I'm not mistaken. Let's go ahead and check out this chart. Yeah, so yeah, they're my biggest dividend payers in the bunch. WP Carey's number one, Realty Income is number two. But WP Carey has traded pretty much flat over the last 5 years, and that's where I think this company is underappreciated. Because in the last 5 years, this company has managed to raise that dividend, not only every year, but every single quarter without fail, and this company has grown its revenues, grown its profits, increased the amount of properties that it owns, and there's just all the more reason to own this company. And so the way I look at it is that if this company's trading almost exactly the same price that it was 5 years ago, and even still much lower than it was before the pandemic, why is this company still being valued significantly lower than its all-time high of $90+ a share, 93 around its all-time high? Even today, while I was buying heavily in the mid 60s, even at 75 again here today with the uptrend, I still think it's a great buy. I love this company, and the same thing goes for Realty Income. This one is starting to really recover, but it doesn't matter because this company is going to be fine. Shutdowns, no shutdowns, this stock is going to do just fine. And it's pretty much the same story. In the same way that this company has went pretty much nowhere over the last 5 years. 5 years ago, this company was a $64 stock. Today, it's 68. Basically nowhere, right? But this company was being valued in the $80+ range just a year or two ago. And this does not justify any of the growth that this company has experienced. Once again, this company raises that dividend 3, 4, 5, 6 times a year. I mean, it is constant, a minimum of every 3 months, right? And that dividend has increased, the revenue has increased, the profitability has increased, the amount of employees and the amount of properties that they own has gone up. I don't know what else to say about it. These triple net lease real estate companies are beautiful. They cash flow like crazy, and they're legally required to pay dividends. So I can really see a scenario where they don't pay dividends in the long run. So two that I'm bullish on. And speaking of one that I'm bullish on, I've talked a lot recently over Visa. And finally, this company is breaking back out to new all-time highs compared to where it was before the pre-pandemic levels. Before the pandemic, it was about 210, and now it's upwards of 230, 240. And this company is finally starting to get valuations that are justified. Now, I know that Visa trades at a high premium relative to its peers, but I don't care because I am so bullish on Visa that I don't think it matters really to me so much, and it's very, 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 very rare for me to say this, that I don't really care a whole lot about the valuation of Visa. I don't really care if it's trading at 150 or if it's trading at 300. I'm going to buy it the same because I'm so bullish on the business. I'm so bullish on the business model and how profitable, let me rephrase that. I'm so bullish on how ridiculously profitable a company like Visa is. I mentioned that about 48 cents out of every dollar of revenue turns into net income for Visa. 48 cents. So that's almost half. Traditionally, just to give you an example, a company like, for example, I know it's a completely different business model, but just to put it in perspective, a company like Walmart, for every dollar revenue they get, a couple pennies ends up on the bottom line, like 3, 4, 5%, depending on the products and groceries that they sell, right? And the same thing goes for one of their competitors, like a Target, great company. And even an Amazon, a giant, a Goliath like that, has margins that are nowhere near what Visa can have to offer. Visa is one of the best high margin businesses in the S&P 500. That is the reason why this company has such a large market cap, because not only can this company steadily raise that dividend 10, 15, 20% a year, which is already incredible, the amount of share buybacks that this company does is unprecedented. You can't even compare it to other companies because it's so large. The only company that I can really think of that, or two companies that I can really think that are even close to it, which are double and triple the size of this company, actually even more than that, is Apple and Microsoft. And they're 3, 4, 5 times bigger than the size of Visa, and Visa stands right next to them as far as share buybacks goes. So regardless, this company will raise that earnings per share just on the buyback alone from the massive profitability, and with those incredible cash flows, it gives them opportunity to buy out other small companies as well. So Visa, one I'm betting on, one I don't really care about the valuation on. We're up 131 bucks on it. Great. I don't care, green or red. I'm gonna buy it either way. Now, next up, we have 5% of my portfolio targeted towards Home Depot, especially a specialty retailer and one that I've had very good returns on. I increased my position heavily during these levels in early March when it was 250, 240. I bought this company heavily, and unfortunately, where'd my deal go? I was buying it like crazy at 250, and now it's over 300, and now almost to 350, and that is just in the span of a month or two. This company has had excellent returns throughout the pandemic. While people were selling out of the stock like crazy during the pandemic, I was buying it. When this company was trading at 160, 180, 190, 200, that's when I was buying my shares, acquiring at cheaper prices, shot up to 300 almost, and now look at this. This company is one that I'm betting on to be successful, and one of my largest holdings, one of the only financials companies that I own because it's the best. And speaking of one of the only stocks that I own in the industry, we're going to look at the only healthcare company stock that I own, because this company is the best of the best when it comes to healthcare stocks. I've mentioned it before. They have a history of growing their earnings per share decades into the past. They also have a history of growing that dividend decades into the past. Guess what? If you invested in the stock in the 70s, it was a good investment. If you invested in the stock in the 80s, a good investment. 90s, good investment. 2000s, 2010s, and in my opinion, going into 2020s, it's still a good investment. There is never ever during any market conditions a time that I could say, wow, I really don't want to own Johnson & Johnson. For me to want to sell out of this company, things would have to materially change in a massive way. And so that's why I'm going to continue to buy the stocks. And that's why I'm going to continue to buy the stock steadily, regardless of where the share price goes. Goes up, goes down, stays flat, don't care, buying more shares, going to raise dividends, going to buy back shares, going to grow the company. And as they acquire new pharmaceutical and medical companies, it's just going to continue to grow revenues and profits. And I couldn't see a scenario where Johnson & Johnson wasn't around 10 years from now. So that's a good company that I love, and one that's really diversified and one that's really defensive in my portfolio throughout any economic conditions. While they might have downturns when the economy goes down, they are very cyclical. It's one that pretty much has to stay around because they produce so many freaking products. 60,000 products are produced by 3M, and this company is starting to turn back around. This company currently has a dividend yield that is almost 3%, and is starting to get a little bit lower because that share price is really starting to recover. During the pandemic, it fell to almost $100 a share. $100 a share, and now it's over 200. Once again, returns do not always have to be big, hyper, super growth stocks, right? And even just a couple months ago, you could have bought this stock in the 150s, the 160s. Once again, now it's upwards of 20, 25, 30% from those levels. Now it's trading over 200s. And in that time, they've also raised that dividend as well. Throughout the pandemic, throughout the time where this cyclical company does hit a little bit of a downturn during the pandemic. But this company is one that I love, very diversified, has a long track record, and one that as it's restructuring its business, I think will get back to massive profitability and back to all-time highs. One that I've talked about arguably the most on this channel is Lockheed Martin. Lockheed Martin, I love it. New CEO, awesome. Incredible profitability, great. contract with governments that sometimes last decades into the future, a backlog of orders that is in the billions and billions and billions of dollars. This company is super innovative, mostly because they have to be. Their number one customer is the Air Force, and that is a situation where I couldn't see a scenario where the U.S. government would let this company ever go bankrupt. The Army, the military, they need this company for its products, especially the Air Force, right? It trades at a PE that is so much lower than its peers, so much lower than competitors and just the general market, but has a dividend yield that is 50, 100% higher than the S&P 500, but also the dividend growth as well, not just the yield, but the dividend growth is probably about double that of average in the market. It has been steadily raising that dividend every single year, about 10% steadily. So not only do you get great share price returns, great dividend raises over time, but you have a company that's forced to be innovative, fully backed by the government, and in my opinion, trading at a much lower valuation than what it deserves to. Just to give you a perspective on how I feel about the company, Lockheed Martin, the only reason I haven't increased it in my portfolio is literally just because I have so many other companies that I don't want to take down. But it's $390 a share today. Once again, take this company to $500 a share tomorrow, I'm still buying it like crazy. For me to sell out of Lockheed Martin, it would have to get to prices that are just ridiculous. For me to sell Lockheed Martin, in 2021, it would have to get to a price this year of say like maybe probably close to $1,000 a share. Literally, it could probably go to 700, 800, and I would probably still be on the fence. Once it got to 900, 1,000, which obviously isn't going to happen. If it were to get to like 900, 1,000, that's probably when I'd be like, okay, it's time to let go of this company. We can get it at a better share price later. All right. But Lockheed Martin, one that I love and one that I'll be betting on through the future. One that I'm almost break even on due to the bad earnings report that just came out is Kimberly-Clark. 5% of my portfolio as well. Very defensive. And they had a big downturn from 142 just to 129 in the matter of like a couple days. So for a company that's a boring, slow-moving stock like Kimberly-Clark, that's a big deal. And speaking of boring and slow-moving, you can see from its 5-year chart, it pretty much trades flat. It doesn't go a whole lot. It just slowly upticks over time as this company increases its prices, increases its profitability. But in the meantime, as that company trades flat, this company will continue to raise its dividend. 2016, 92 cents, 97 cents in 2017, $1 in 2018, $1.03, 2019, $1.07, 2020, now they're up to $1.14 in 2021. As this company continues to raise that dividend yield, if the share price does not move up with it, then you're getting a better and better valuation because you're getting a better dividend yield, more than likely a lower PE ratio long term. And that's why this company, while it was being valued in the 150s and the 160s just the other day, now it's in the 130s and it has a dividend yield that is 3+% with a compelling dividend growth of raising it about 6.5% just this 1 year, even when a time when commodity prices for this company are rising. So Kimberly-Clark, one that's very defensive. Basically, the way I look at it, people are always going to need to wipe their butts. Okay, I do it, you do it. It's not stopping anytime soon. Kimberly-Clark gets paid every time you wipe her butt. So go ahead and use their products that way and get paid for it. PepsiCo is one of my favorite. I've talked about it so many times on the channel, and I am a huge Mountain Dew fanatic. Hey, look at that. Excellent Green Day. Went up 1 penny. Wow, we're making such big gains on the stock. Huge. Went up a penny on the day. Heck yeah. But this company long term will continue to buy out other smaller brands in the space in the snack and food business. And also, as this company is traditionally known for just its drink products, like obviously Pepsi and Mountain Dew, they have so many other big and smaller names that you've probably haven't even heard of all of them. But there's so many names diversified in the business that it's sometimes hard to recognize how diversified Pepsi really is. And just to name a couple off the top of my head that a lot of you know, obviously Mountain Dew and Pepsi, like I just mentioned, but they also have things like Stubborn Root Beer, and they also have things like Propel Water, and they also have Aquafina Water, for example. They also have other drinks as well, including Gatorade. Their snacks, they have things like Quaker Oats and Lay's and Off the Eaten Path and Sabritas and Sabritones and Grandma's Cookies and Aunt Jemima Pancake Syrup, and all different types of products are owned by this company. There's so many brands. Oh, and just by the way, just to give you another example, they just bought out Rockstar Energy last year. And so now, as that deal is finally starting to finalize, that should be showing up on their bottom line as well. So Rockstar is another example of how this company continues to slowly grow over time as the population grows and we continue to consume more and more food and beverages. Guess who's going to sell it to us? It's going to be Pepsi, and they're going to make money off that. So that's why I own a piece of their company. Procter & Gamble sells basic household items that you take for granted every single day. Just basic things like diapers and paper towels and shampoos and deodorants and feminine care products and lots of other things like that. There are such a diversified portfolio of brands in Procter & Gamble. And the same way when I said with Pepsi, and the way that they're diversified between snacks and drinks and they're just so big in the space, the same thing goes for household products with Procter & Gamble. It doesn't matter if you're talking about toiletries or feminine care products or deodorants or hair care products or health and wellness. Like, it doesn't matter. Procter & Gamble probably at least has one or two brands in every one of those categories that go along with buying items from your home. It doesn't matter what you buy or what you're interested in purchasing at Walmart. When you go down the aisles of the household products, you're going to see Procter & Gamble products everywhere, and I mean everywhere. And so steadily over time, they'll continue to add to that portfolio of brands, continued profitability, and that's the same thing with like a Pepsi. As they get bigger and bigger slowly over time, raise the dividend, share price goes up, buybacks increase, this company continues to get bigger and bigger. And that's why me as an owner, I love these two business models. Very similar in the sense that their portfolio of brands is so diversified, but they're just in different categories. Procter & Gamble focus on basic household and healthcare products, and then Pepsi is focused on snacks and drinks. Equally great companies, two that I love 110%. Southern Company is one that is 4% of my portfolio, and this is one of the most boring stocks in my portfolio. And this once again goes to show how boring is sometimes good. Now, why this company won't have massive returns? This is a stock that is going to trade very, very, very slowly. As far as the share price goes, don't expect huge returns. It might have 10 or 20% growth times, and where if you buy it during a dip, you might be able to get some decent gains. But generally speaking, this company is going to be boring, and the reason why it's so boring is because this company does nothing but provide natural gas and electricity to homes. Not exciting, right? But in that time, once again, same thing as always, goes up over time, increases dividends, one that is regulated by the government, so it doesn't really have a whole lot of leeway for what to do with this business model. And in some ways, that's a good thing because you know what to expect. There's not going to be some type of huge innovative thing that this company comes out with. They're going to do the same thing today that they're going to be doing 5 years from now, providing electricity, providing natural gas, and that's what this company does, but it does it well. And that's why this continues to be one of my biggest investments and why it is a steady dividend payer, usually having yields of over 4% throughout most of these markets. In a time where stocks are at sky high valuations, a 4+% yield really helps cash flow into my other positions. So if I'm getting big dividends from Southern Company, that extra revenue in the form of dividends being paid out to me in the portfolio can feed into more other investments. If I get a $5 or $10 dividend payment, I can put $1 in Procter & Gamble. I can put $1 in Lockheed Martin. I can put $1 in McDonald's or Caterpillar or whatever the case may be. But you get the point, Southern Company, a boring long-term stock. And speaking of boring long-term stocks, like most of these, we have Coca-Cola, which is kind of like the old school version of Pepsi. It's one that's had a lot of trouble here in the last couple of years with slowing revenue, but it does have massive profitability, and it is getting back to a comeback story. Back in the 80s when this company was an incredible investment, it didn't quite have the returns that it does today compared back to its glory days, but I think it can get back to a growth story while it can transition into fighting back for its big competitors like Pepsi. And the way I look at it is that if I own Coca-Cola and Pepsi, I pretty much own every important beverage on earth. If you name any big drink brand, I'm sure that there's if you just pick one brand, okay? Just pick one drink off the top of your head, okay? You got it? Think of one soda, one water, one whatever. If you think of just one beverage brand, it's more than likely that you thought of a Pepsi or Coca-Cola brand, right? It's probably like a 50, 60, 70% chance. So the way I look at it is that every time someone takes a drink of something, it's more than likely that I just got paid. Doesn't matter what they're drinking, whether they're drinking coffee or whether they're drinking water or an energy drink or sparkling water or whatever. If that's the case, every time that happens, I'm more than likely going to get paid. So that's why I'm owning Coca-Cola, one of Warren Buffett's favorite holdings that he's been owning since decades back in the past, but one that I love to own and one that I'll continue to own in the future. McDonald's, basically, I've mentioned it all the time. If you haven't seen The Founder, go watch it. But this company owns the real estate behind all the McDonald's locations that you see. So not only will they get paid in the form of franchising fees and other things like that, but as they continue to sell more burgers and fries, this company will obviously get revenue from those products, but they lease out their properties to the franchisees that are trying to start those restaurants. They'll buy the land and then say, hey, pay us rent every month. So it doesn't matter how much burgers and fries they sell. I mean, it does matter. But what's more important is that over time, they will continue to have more locations built out. They will raise the rents on those franchisees. And it's really kind of like a real estate company that also sells burgers, like if that makes sense. So that's why McDonald's has grown to a Goliath. That's why they're almost a $200 billion company. But over time, they continue to raise that dividend steadily, grow revenue steadily. It's a boring stock that will typically grow revenues and profits in the rates of something like 1 to 5% a year. Steady, slow growth, like I said, as they build more restaurants and things like that. But one that I'll continue to hold as they get mass profitability. Caterpillar, I always talk about one of the most unexpected big returners in my portfolio being Caterpillar. And once again, guess what we have today, everybody? Another all-time high. Good Lord, has this stock flown to the moon. And the investor sentiment of this company is like, it's unreal. It's crazy. Like, I'm considering it's like, it's getting to the point now, it's like, do I continue taking it down in the portfolio? Because I've lowered it from what I believe its original target was like 5% of my portfolio back when it was at these levels at under 150, and I was buying it like crazy. And then it went upwards to the high 100s, and I said, okay. And then it went to 200, okay, 225, 230, and now it's up to 240 plus. Let's see, what is this? So like right here, today was all-time high, and went up to about 242. So when I was buying this company at $120, $130, and today it's trading at $242 a share, it's not the same company. This company is being valued significantly higher. And part of it's justified, yes, with obviously the infrastructure bill and what's moving forward. But the bullish sentiment of this company is so massive. Investors are so positive on the stock that it makes me want to hold the reins, hold back a little bit, because I bought my shares early when it was cheap. And now that it's expensive, I want to focus on some of my other stocks that are still cheap. But when we look at Caterpillar, massive returns have come for a lot of reasons. But Caterpillar is one that I love, and they sell such profitable, incredible big machinery to businesses. They have great brand recognition, and they're going to be one that's going to be successful, especially as this infrastructure bill and things like it move about, at least in my opinion. And that's why on a money weighted return, well, while I like time weighted returns better, the money weighted return is massive on this. I've owned it for a little over a year, and the money weighted return is about 130%, so pretty incredible. Altria is one that is a turnaround play. Mentioned it many times on the channel. As smoking gets bashed, I continue to invest in the stock. Everybody's negative on Altria. No one wants to invest in tobacco, right? Who cares about the tobacco industry? Well, when they're offering you 6, 7, 8, 9% yields to invest in it for an opportunity for growth into a marijuana space and alcohol beverage investments and other joint ventures like Hexo Corporation, Altria is going to move away from that legacy business into more new age investments that are going to be more reliant on people like my age, right? In their teens, in the 20s, and 30s. And my age group is really going to have a different story and a different look towards Altria 5 years from now, 10 years from now, than they do right now. I think that not only will this company very slowly grow over time, but I think the valuation, I think that the multiples will be expanded on this company slightly over the next 5 years. I think once people realize tobacco is not going away and that it's going to be here probably, I hate to say it, but probably the rest of my life, then Altria is going to start getting valuations that are a little bit better than what it's being justified at, because the profitability is ridiculously big. And that's what causes this company to have dividend yields that are 6, 7, 8, 9, and even at one point in 2020, 10+% dividend yields. While not only that have they maintained that dividend yield, they've continued to raise it year in and year out. Actually, speaking of which, yeah, we're due for another dividend raise here in about 3 or 4 months, so stay tuned for that. But Altria, one that I'm betting on for a turnaround play. Next up, we have Store Capital. Without going into too much detail, in the same way that I told you guys I invest in WP Carey and Store Capital, or excuse me, WP Carey and Realty Income, the same thing goes for Store Capital. Store Capital, triple net lease real estate company, and the same thing, it's kind of like the little brothers, the smaller version of those other two companies that I mentioned. This company still has a great yield, it's still recovering massively because the selling pressure in 2020 from this company was massively overblown and went from a $40 stock, right, down to about 15. well over a 50% downturn. What is that? That's like a 60% downturn or so, right? 60% downturn off of the pandemic. And this company did not even get hit all that hard from revenue and profitability, but maybe say 6 months they downturned a little bit, but now they're right back to where they were and back to their record numbers, but it's still being valued much lower than it was and still has a fantastic yield. And also their CEO, Christopher Volk as well, is very, very good at running this company. And go ahead and check out some of his Seeking Alpha articles if you haven't. I've showcased this before on the channel, but some of the Seeking Alpha articles that he writes is very interesting. Whirlpool. Look at the money weighted returns. This is why I don't follow money weighted returns, and I think time weighted returns are a bit more reliant. But based off a money weighted return, we're up 511% on my investment that I just made back in a Whirlpool back on March 8th. So just about 2 months ago. March 8th, I decided to invest back into this company. And whew, was that a good decision? Because I was buying this company under 200. So March 8th. Let's see. So it would have been right at $200 a share. And today it's at 250 in the span of 2 months. That is a huge uproar, right? That is a 25% increase on a time weighted return. That's a 25% increase in the last 2 months. That is craziness. And this company, I hate to say it, it's not at the prices I want to buy it anymore. I want to buy it at the 200s, not the 250. Okay, so I'm missing the deals that I could have had just earlier, but the good news is I'm at least getting some of those gains now. And as this company has continued to raise dividends, even doing that twice in the last 6 months. It's raised dividends twice in the last 6 months, guys. It's went from $1.20 to $1.25, stayed that same payment one more quarter, and now they're up to $1.40. This company has raised dividends massively. They're doing share buybacks. They're growing profitability. And this is a company that's benefiting massively from the stimulus. Who knows how long this will stay, but I'll continue to follow this company. And as for now, I'm still an investor in this company. I wish it was still 200 or even below 200. 250 is not as attractive as I wanted, but it still has a much lower valuation than I think people justify it for. NextEra Energy Partners, the only energy company that I own. It's a renewable energies business with a great dividend yield and a fantastic dividend grower. This does not raise its dividend every year, but raises it every quarter. And when you look on a quarter over quarter basis, the dividend raises are usually something like 3, 4, 5%. But on an annual basis, this dividend is usually getting raised 15, 20%. So the dividend growth is absolutely incredible for this company, okay? It is a company that continues to raise that dividend in a massive, massive way. And so as the share price continues to go up over time, the dividend will follow right behind it. I think that this could be a big winner. And while I'm not too confident in the energy space and it's not my specialty, I think it could be a big winner long term. And it also gives me a little bit of diversification in the portfolio. Waste management, I've talked about it many times and just mentioned it recently on a video. It's at new all-time highs just here in the last week or so. And it was just the other day, just about 2 or 3 months ago at 110. Now it's upwards of 140 plus. And I hate that, and that's because I am not getting the type of deals that I was in this company. But what's really interesting is that I'm sure a lot of you have heard how Bill and Melinda Gates have just recently announced that they'll be getting a divorce. Waste management is their second largest position. Now, I don't know this. This is all just speculation, just a guess. I wonder if that divorce will force liquidation of some shares, especially probably from Bill, who's probably the owner of Waste Management. If he's forced to liquidate half of his shares to give them to Melinda, could see a little bit of a downturn, a little bit of selling pressure in the stock. Not only could that have him force him to sell his shares, but it could also create some negative sentiment, which has nothing to do with the business. That's one of the things that I love in the stock market. You could have something take a company down 5, 10, 15% on something that has nothing to do with the material change in the business. If he sells the shares, let's just say if the biggest investor tomorrow sold Waste Management shares and took the stock down to $100 a share, okay? That changes nothing for Waste Management. In some ways, it's actually better because their buybacks mean that they can now acquire more shares, and their dividend yield, okay? Their dividend yield will get much higher. Their PE ratio will get much lower, and you as an investor now have more of an opportunity. I would absolutely love if this business stayed the same tomorrow, but for some negative catalyst such as a Bill Gates or someone else selling out of this company were to take it down to 100 or whatever, that would give me all the more reason to buy it. So Waste Management, one that I love. And then last but not least, we have one that just was announced by Warren Buffett as one of his most recent investments, and one that I've been investing in for a little over a year now is Verizon. Great dividend yield of 4+%, slow dividend growth over time. It's kind of like, in my opinion, kind of like the cousin to AT&T, right? It's a telecom company, boring, provides cell phone service, internet service, but basically over time, as cell phones and cell phone services get more expensive, and this company rolls out its new 5G services, I think that this company will continue to have big profitability because these telecom companies only do one thing well as far as an investment goes, in my opinion. They produce lots and lots and lots of cash flow. And so in the same way that like my number one investment, Broadcom, experienced a lot of growth, a lot of dividend raises, and continues to feed off massive cash flows, it's the same thing with Verizon, except it's a much slower grower. Instead of growing revenues 5, 6, 7% every year, they might grow revenues 1 or 2% every year, and the same thing on the bottom line. But they still produce a lot of cash flows, and they're very defensive. And the same thing for like a Broadcom, except they're kind of like the new kid on the block that's growing a lot faster. But thank you guys for watching all the way to the end. Like I said, if you enjoyed these monthly updates and you want to stay tuned with me, go ahead and subscribe and get signed up with M1 Finance. $30 just for getting signed up. I'd really appreciate it if you do so and you'd help support the channel. But thank you guys so much for watching, and I'll catch you guys next time.